On September 15, 2008, the CEO of Lehman Brothers faced a choice. 6 months earlier, the federal government had rescued Bear Stearns, its closest competitor, with a $29 billion bailout. Richard Fuld, who'd run Lehman for 14 years, expected the same treatment. He was wrong. At 1:45 in the morning, Lehman Brothers Holdings filed for Chapter 11 bankruptcy. The numbers were staggering: $639 billion in assets, $619 billion in debt. It was, by a massive margin, the largest bankruptcy in American history. The decision to let them fail, instead of doing what they'd just done for Bear Stearns, was deliberate. Treasury Secretary Hank Paulson said there was no political will for another bank bailout. The Fed chairman said Lehman lacked the collateral to make a rescue legal. Neither explanation was wrong, both were true. And that contradiction, that messy, inconsistent contradiction, is what broke the financial system. Because the moment the market realized the government's rules were negotiable, trust evaporated. Before Lehman collapsed, almost nobody outside the bank knew what it actually held. The public story was subprime mortgages, bad bets on housing. That was true, but it was only half the picture. Lehman's real problem was leverage. The bank didn't just own mortgages. It had borrowed enormous sums to buy even more, a strategy that worked perfectly when prices were climbing. When they stopped, the math became lethal. Here's the mechanism nobody talked about. Lehman was a counterparty in thousands of financial contracts. When other banks needed to hedge their own risks, they signed agreements with Lehman. They paid Lehman. Lehman promised to pay them back if something went wrong. For years, nothing went wrong. Lehman collected fees. The agreements sat dormant. Then the housing market cracked, and every single one of those contracts started screaming. Banks around the world suddenly realized they had exposure to Lehman that they couldn't measure. How much did we lend to them? How much do they owe us? What happens to our pension funds if they disappear? The fear wasn't rational or irrational. It was precise. If Lehman filed for bankruptcy, every bank connected to them faced immediate losses. Not theoretical losses, real ones, today. And on the morning of September 15th, it happened. Within hours, banks stopped lending to each other. Not because they ran out of money, because they didn't know who was still solvent and who was already dead. The system had seized up, and it wouldn't restart for weeks. The moment Lehman's bankruptcy went public, the panic didn't hit stocks first. It hit somewhere nobody was watching: money market funds. Most people have never thought about money market funds, and that's the point. They're the boring plumbing of the financial system. A pool of short-term loans between banks and corporations that mature in days, not years. Trillions of dollars sit there. Payroll accounts, corporate cash reserves, pension funds parking money overnight. It's where money goes when it needs to be completely, absolutely safe. And those funds held billions in short-term loans to Lehman Brothers. By that afternoon, one of the oldest money market funds in America, the Reserve Primary Fund, announced it was breaking the buck. Its value had dropped below $1 per share. That phrase sounds technical. It isn't. Money market funds exist on one promise: a dollar in, a dollar out, always. Breaking the buck means that promise failed. In the entire history of these funds, it had happened exactly once before. And here's what turned a loss into a stampede. Every other money market fund in the country also held short-term corporate debt. Nobody could tell, from the outside, which ones held Lehman paper and which didn't. So investors did the only rational thing. They pulled everything. Within days, hundreds of billions of dollars fled money market funds. The Reserve Primary Fund alone hemorrhaged tens of billions in redemptions. But the real damage was upstream. Those funds were the machine that lent corporations the cash to make payroll and keep the lights on. When the money fled, that machine stopped. Companies that had nothing to do with mortgages, airlines, manufacturers, retailers, suddenly couldn't borrow to cover next week's wages. The crisis had jumped from Wall Street to Main Street in about 72 hours. The next domino was already falling before Lehman's paperwork was filed. AIG was the largest insurance company on earth, not an investment bank, an insurer. The kind of institution that sells life insurance to school teachers. But buried inside it was a small London division that had quietly sold something else: insurance on mortgage securities. They were called credit default swaps. The idea was simple. A bank buys mortgage bonds, then pays AIG a fee. If the bonds fail, AIG covers the loss. For years, the bonds didn't fail, and AIG collected fees on hundreds of billions of dollars of exposure without setting aside much to pay claims. When housing collapsed, all of it came due at once. 2 days after Lehman died, the Federal Reserve seized control of AIG with an $85 billion emergency loan, taking a stake of nearly 80% in the company. Read that sequence again. The government refused to save Lehman on Monday. On Tuesday, it nationalized the world's biggest insurer. That's when the market stopped trying to predict anything. If the rules could change in 48 hours, then no institution was safe, and no promise was reliable. So banks did what any rational player does when the rules dissolve. They stopped lending to each other entirely. Interbank lending is invisible to normal people, but it's the bloodstream of finance. Banks lend each other billions overnight, every night, to balance their books. The problem was no longer bad mortgages. Mortgages were the wound. The infection was doubt. A bank that can't borrow is already dead. It just doesn't know it yet. Then it stopped being about banks at all. When credit freezes, the damage doesn't stay in finance. It moves outward, into every part of the economy that runs on borrowed money, which is nearly all of it. Businesses that had never bought a mortgage security found their credit lines cut. Orders were canceled. Payrolls shrank. And because one company's spending is another company's revenue, the contraction fed itself. In the United States, roughly 9 million jobs vanished in the recession that followed. Unemployment doubled, peaking at 10%. Around 10 million American families lost their homes to foreclosure. Global stock markets erased trillions of dollars in value. Household wealth in the U.S. alone fell by roughly $16 trillion from its peak. Retirement accounts, home equity, savings, gone in under 2 years. And the response was the thing nobody had believed possible 3 weeks earlier. Having refused to rescue Lehman for $700 billion worth of political reasons, the U.S. government turned around and asked Congress for exactly that. $700 billion to buy troubled assets from the banking system. Congress rejected it on the first vote. The Dow fell 777 points that day. At the time, the largest single-day point drop in its history. 4 days later, Congress passed it. Across the world, governments did the same. Britain, Germany, France, Ireland, Iceland, each with its own version of the same emergency arithmetic. The total public cost is still argued over, because much of the money was eventually repaid. But the cost that was never repaid is the one that mattered. The years of lost work, lost homes, and lost savings belonging to people who never held a mortgage security in their lives. They didn't take the risk, they just paid for it. So, did one bank cause all of this? Honestly, no. And the way people answer that question usually reveals what they want to believe. Lehman wasn't the disease. It was the moment the disease became undeniable. The bad mortgages were written years earlier. The leverage was built years earlier. Bear Stearns had already nearly failed 6 months before. The system was primed to break, and if Lehman hadn't been the spark, something else likely would have been. But that doesn't make Lehman irrelevant, because of what its collapse actually destroyed. For decades, the financial system ran on one unwritten assumption. If an institution is big enough and connected enough, someone will catch it. That assumption was never a law. It was never a written rule. It was just something everyone believed. On one Monday morning, that belief was tested, and it failed. That's the pattern worth remembering. The mortgages were the cause. But the collapse spread at the speed it did because confidence is the actual load-bearing structure. Remove it, and everything built on top comes down, regardless of how sound the paperwork looks. Which is the uncomfortable part. That structure hasn't changed. The rules are stricter now, the capital buffers are thicker, but the system still runs on the belief that the people at the top will act predictably when it matters. That belief has been wrong before. And when it breaks, it never breaks slowly. If this changed how you think about the machinery underneath your money, like the video, share it with someone who'd find it interesting, and subscribe to Curious Black. I'll see you next time.